Happy New Year, everyone. Thanks for joining us again, late in January here, 2025. As usual, it's Martin and I talking about markets and kind of what we see going forward, and lots of exciting things to talk about. New political regimes, politics here in Canada is changing, and all that affects economies and markets. So we got a bunch to talk about. Also, we're going to introduce the newest member of our team, so you get to see her right at the end of the interview. So with that, let's go ahead, Martin.
Yeah, definitely. Let's dive in. So, as usual, we're going to discuss the economy, interest rates, and markets, but we also want to point out some important aspects of the market today and why, an investor should have active managers in their portfolio to navigate the years ahead. And secondly, strategies in their portfolio that can weather and even perform well in volatility. Can you talk a little bit about active management, Bob, and what do we mean by it?
Yeah, everything, and we talk about this a lot, everything in the market cycles, and it's called reversion to the mean. So when things get right outside of the normal, comes back. If it rains a ton in Vancouver, then it's going to be sunny for a while. If it's too sunny for too long, then we're going to pay for it with getting rain. So everything averages out. And back to the money management. Indexes have done fairly well over time here, and what that's done is it's kind of sucked everybody into just thinking that if I invest in an index, that's not going to go down. I'm not going to lose money. I'm going to do better forever. And I think we're coming to the end of that. Things are going to change. Active managers are kind of a thing of the past. In other words, people that actually look at stocks and analyze stocks and use their brains to figure out what the best place to be is. That hasn't been rewarded for a period of time here. And, looking at that in the markets, I think it's going to come back, and we're going to start to see a lot of similarities to what we saw 25 years ago, and we'll talk about that more as time goes on. But I think active managers can also be, proactive, reactive, adaptive to the market environment. And that's, I think, really gonna take hold in the next little while, since a lot of these indexes are kind of focused on a very small number of stocks, and people will be rewarded for, I think, their intelligence in the future. People haven't been rewarded for their intelligence in the last couple of years necessarily.
Yeah, exactly. Price is what you pay and value is what you get. And
Sure.
yeah, we'll dive into active manager and a little bit later on and how they're actually seeking out this value. So
Hmm.
let's just shift gears and just talk about the economy and interest rates. It seems like the economy remains fine in Canada. It's definitely
Right.
slower and weaker than in the US. It's growing at 1.5%
Hmm.
annualized versus the US, which is closer to 3. So clearly the US is growing faster and has a lower unemployment rate. Canada has actually been, increasing a little bit lately. And that's tied into a stronger US dollar. You know, how has this factored into interest rates and the differential between the two countries? And how does that impact the US dollar at the end of the day?
Yeah, we're in a bit of a pickle here in Canada, and I think that creates opportunity, right?
Yeah.
Everybody gets overly negative. I remember I was having this conversation back in January of 2016, when the Canadian dollar was kind of hitting a low, commodity cycle was at a low, and then right at the point of maximum pessimism, things turned up. So I'm not really as pessimistic about Canada as a lot of people are, but what we've had here is some issues, and that is we've had a large amount of immigration, which is great for the country, but our GDP, in other words, we haven't been growing to keep up with that. And what happens then is the productivity per person has gone down in Canada, and that's why things seem okay but don't feel so good, right? And that's what Canadians are dealing with. They look at the numbers and say, why do things in the numbers look pretty good, but I don't feel so good? And that's because of that productivity per person. So that's something we got to deal with. I think that'll probably pop back at some point here, because everything, remember, is a self-righting mechanism. What is the cure for a low dollar? It's a low dollar, right? Because when the dollar's down, business comes back. We can talk about that in tariffs in a few minutes, but it's a self-righting ship or self-righting mechanism. So yeah, interest rates have come down in Canada from about 5 to about 3.25%. They might pause a little bit. In the US, interest rates have come down by 1% too. But we've talked about this before, how on the short term, it seems like a great thing that interest rates have come down. But if you go to get a mortgage, the rates really haven't come down at all for a fixed rate mortgage. So long term rates are going up, short term rates are coming down, and it's a confusing environment. And once again, we've got a 100-year event happening every year or two. And I've talked about that for a few years. We've never seen this before where interest rates have come down on the short end, and on the longer end, they've actually gone up. So that's obviously a challenge. The Bank of Canada is worried about employment, and they're also worried about inflation. So it's going to be tough, I think, in the near future to fight both. They're going to have to choose one. And I think they'll probably choose employment because that's the voters. That affects the voters. Inflation doesn't as much.
Yeah, I completely agree. And our economy's just been far less productive. One of the leading industries of our economy has been real estate. And you build a house that creates some temporary jobs, but once the house is built, that's about it, right? Where if you built a company and you hire people and you're growing that company, there's sustained benefits over time, and we're
Sure.
just not seeing enough capital investment into Canada. But like you said, a weak dollar and maybe a changing political regime could change that. So that's one other point. We're facing some political uncertainties with our government
Mm.
at a time when President Trump is threatening tariffs on us. What are your thoughts on these potential tariffs?
Yeah, it's funny. Before Trump was president, or even thinking about that sort of thing, I read his book in 1987 called The Art of the Deal, and I still have it in my office. And I think that's relevant because that kind of framed his worldview and framed the way he looks at things. So everything to him is transactional. Everything is a deal, all right? And I'm going to create enough pain for you that you're forced to come around to my way of thinking and make a deal with me. So that's why the sledgehammer comes out always at the beginning. And I think we should pay attention to actions a little more than words. There'll be some tariffs, there'll be some disruptions here, but everything's a negotiation, right? And in 2026, we've got kind of the end of the agreement between Mexico, Canada, and the U.S. on trade, and obviously, the more pressure that's applied now, the better the deal in his mind in 2026. So that's just something to think about. The problem with having that sort of forceful nature in deal making is that if everybody knows your playbook, then it doesn't matter really as much anymore, right? So you got to come out as a surprise in a lot of things. So it's not a big thing. We just got to kind of deal with it. It's can cause some problems for Canada down the road, but I think what's most important is just to take it one day at a time and be adaptive, because it's kind of like a moving target that you're trying to follow here. There's lots of things going on in the world. There's lots of ways that things are going to revert back to the mean. If the Canadian dollar goes down too much, that's a problem actually for the U.S., and the U.S. wants the U.S. dollar to actually come down compared to other currencies. So they're gonna try to get the U.S. dollar down compared to other currencies. So once again, what's important is not what people think, but how the market is reacting to what people think.
A lot of areas of the market have already priced that in. We already have a much weaker Canadian dollar. You're seeing areas that might be impacted by the tariffs, whether it's industrials or energy, have sold off or are just holding in there as capital is waiting to be deployed in these areas until there's some certainty. So we'll
Right.
definitely provide some updates as we go along.
Right.
But one of the most important points you always bring up is the economy is not the stock market. We spoke
Sure.
about the economy and it's, growing slowly, but the stock market has done fairly well. And in Canada, it's actually performed well as well. So what are your thoughts on the markets today, and specifically Canada versus the US and the rest of the world?
Yeah, and I think the market's not being the economy is a great suggestion, because that's absolutely true. And that's why economists who run money usually do very poorly, unless you're doing short-term trading. The more that you focus on kind of the macro or the really big picture, which has multiple variables and inputs, and each variable is dependent upon another variable, which is a variable, you can see it's almost impossible to figure that out. So the best people over long periods of time managing money are people that don't really pay a lot of attention to the big picture. Look at value in the market, look at maybe something that's overlooked, look at a margin of safety, what you can buy that is probably not going to go down that much because there's a lot of negativity already factored into it. And those people usually do the best over a long period of time, not necessarily over the short period of time. But when that gets out of whack, which it has been a lot for the last little while, then it tends to revert back to the mean, and that goes with our thoughts about, the economy is going to do what it does, but if you're invested ahead of that, and if you're looking ahead 18 months rather than forecasting what's going to happen in the short term, I think you'll do a lot better.
Exactly. And that ties into active management, the importance of having active management. So now we're just going to bring up a few slides just to really illustrate that point. So here, the first thing I want to bring up is a chart of U.S. stock market valuations and the following 10-year returns. So the chart that we have on the screen is a collection of data going back close to 30 years, and it plots the starting point of the valuation of the U.S. market, and the gray line is exactly where we are today. And that's at an elevated level relative to where it's been in history, and then the subsequent 10-year returns. And what I really want to highlight out of this chart is every instance from the valuation starting point we've been at today, if you bought the index, so the ETF, you would always earn a return between -2 and 2%. So basically flat over the next decade. Can you comment on this? Because we've just seen, a huge concentration happen within the U.S. market, and there are significant implications for this going forward.
It was very similar to this in 1999, 2000, and it played out. The next 12 years from 2000 to 2012 were flat, zero. So if you bought a U.S. stock market exchange traded fund, you would have not made money for 12 years. And believe me, you wouldn't have stuck with it. You would have gone somewhere else and done something else, right? So, and just at the maximum point of the peak of people doing something else and getting out of the U.S. was around 2012, and they put their money other places. And then, of course, the U.S. started to go up from there. So this is very important, these forward-looking numbers. And what it's showing right now is the market's basically going to have a 0 to 2% return over the next -2 to +2 over the next 10 years. Now, nothing's guaranteed. Things might be different this time, but this is what history has shown. So I think it's important to understand that, there's a set amount of money in the market, and it just sloshes around between different things. So if the U.S. market, which is capital weighted, meaning the biggest stocks represent the biggest value in the market, there'll be lots of opportunities in the U.S. There'll be lots of places to invest, maybe small company stocks or maybe energy stocks that are in the U.S. market. So money will slosh back and forth. And interesting enough, we'll talk about that in a few minutes, but yesterday was this big down day because of something that hit the market right out of left field with regard to artificial intelligence. And we saw money slosh over to other areas. So, a fund that we own for investors, which is a value-based fund, was actually up 1.5%. The alternative version of it was up 4% yesterday. So what that shows you is money's just moving from sector to sector. But when the U.S. market gets completely overweighted in these overvalued stocks, which it is right now, that shows you for the next decade that has to correct. Those stocks might not do anything or come down in value, and it'll look like the market's not doing anything, but there's lots of opportunities. So that's why I hesitate to ever talk too much about the market, right? People like to say, what's the market going to do? And I say, I don't know. It doesn't matter what the market does. There's always opportunities in the market to do well. But I wouldn't be surprised to see, Canadian stock market's not done that great for a few years. I wouldn't be surprised to see the Canadian market start to outperform over time here. But whatever the case is, there's lots of opportunities. International markets have done very poorly over the last few years. So the expectations are very low, and when expectations are low and valuations are low, that's a great setup for winning over the next few years.
And I think that's a perfect segue to our next chart, which you mentioned a lot of foreign investors and what their activity has been. And unfortunately, foreign retail investors have been amongst the worst investors in terms of timing. And the chart I want to highlight here is U.S. equities and net capital inflows from foreign investors.
Right.
So that really measures how much money is going in or out of the U.S. market from international regions, including Canada. And
Sure.
you can see on the chart right now that it's at the highest level. Over the last few months, we've just seen foreign investors pile into the U.S. market at a very high valuation. So they're not really caring what they're paying. They just realize, hey, our markets aren't doing that well. Their market's done great. Let's go in. Well, unfortunately, the last few instances where this has occurred, it really hasn't panned out that well. And that doesn't mean that it's going to happen again. But back in 1986, we had a large influx then, right prior to the 2000 tech bubble. There was another influx. And then, of course, before the great financial crisis, there were a few instances. So they've just been a huge contrary indicator in terms of perhaps to watch and to monitor. So can you comment on past experiences of money piling in at the wrong time that you've experienced?
And yeah, I've been, as I've said before, almost 30 years in the business, so it tends to happen over and over. And, history doesn't repeat itself, but it rhymes. I always talk about that. But sure, you can just feel it, right? Without even looking at charts, you can just feel the pressure, right? And why does money suddenly come in like this? It's called self-preservation for money managers. So money managers who are thinking, who are intelligent, who are looking at valuations get punished because money's flowing into something. Clients say, hey, my next door neighbor's making money and I'm not making money because they're all in the US market. So finally that capitulation happens, whether you're in Switzerland or Germany or Japan or whatever the case is, or Canada. And then you say, okay, I give up. I guess I don't understand. So we're just going to pile into the US market. And that's what you see right there. And it's a self-fulfilling prophecy. The more people pile in, the more the market goes up. So the more people pile in, the more the market goes up. The more people pile in, the more the market goes up. When you get up to a certain point, that everybody who was going to pile in has piled in. And that's the top. And then money starts coming down. So that's why investors a lot of times feel like, why do I always make the wrong decision at the wrong time? Right? Every time I do something, the market goes the other way. And that's because you're being reactive. You're following the market rather than skating to where the puck's going to be. And I should say, well, we'll get into the AI thing in a minute, but I should say that we see lots of signs here of things that we've seen many times in the past.
Yeah, one of those signs happened on Monday of this week, which, was the artificial intelligence breakthrough that you mentioned, which was by DeepSeek. It was an AI model from a Chinese startup. And, there's a lot of speculation around it, but it was the most downloaded app over the last few days. So, people have tested out the software, and the main purpose is they've created an AI model that's just as efficient and uses far less energy, is a lot more energy efficient and doesn't require the strong computing power from a lot of semiconductors. And this raised doubts on the billions that big tech companies have spent in the last few quarters on leading chips and data infrastructure investments. So they might have overspent just to stay competitive on technologies that they just want to stay ahead of the curve, even though it's not really clear on how much profitability it will add for them. Can you talk a little bit about, this breakthrough and how, the environment is shifting and now we're seeing capital start to rotate when these events occur?
We've been talking about an AI bubble for a little while.
Mm-hmm.
And remember, when a bubble, just say your kid's blowing a bubble. The bubble gets bigger and bigger. As it gets bigger, the sides of the walls of the bubble become weaker and weaker. So it becomes easier and easier to pop the bubble. So the bigger it gets, the easier it is to pop. And usually it's something out of left field that comes along and pricks the bubble. Something that nobody saw actually happening. In 2001, it was Enron, right? Which turned out, it was a huge company, which turned out to be a fraud. We've got some fraudulent instances maybe in AI coming up here in the next little while, which we're going to start to see. So it doesn't mean that the thesis is wrong. AI is going to be great. It's going to change the world. But, I've forecasted, in the past year or two that 3 years from now, probably most of the stocks that were going to be big AI stocks are going to be bankrupt, or they're going to be down 90%, and a few of them will survive. And that's the popping of the bubble that happens. I'm just using history as an example. I mean, recent history. Well, how does everybody forget 3 years ago we had the electric vehicle bubble, right? And all these electric vehicle companies, which were going to be the next Tesla, were all going to be huge. They're all down approximately 90% now, except for the big one, Tesla, right? And it'll be the same with this AI, where a lot of these little companies will kind of get destroyed over the next few years. So the bigger the bubble, the easier it is to pop it, and it's always something coming out of left field. So we have this DeepSeek, which I'm not an AI expert, but I know markets very, very well, and I think that's important. Somebody named Howard Marks, who, Warren Buffett says he always listens to. He's a great mind. He wrote a report exactly 25 years ago this week, talking about how he sensed some sort of bubble in the U.S. market. And the bubble popped on March 10th of 2000, right? About 6 weeks later. He recently just wrote a report again, 25 years later, and he says, feels like a bubble again in a lot of these areas. So that's great. We're happy about that, actually, because it creates lots of opportunities. It means there's going to be capital rotation from 2000 to 2002. If you were a value investor and a good stock picker and you bought things with a margin of safety, you actually made money. You did well when the market was down 45% from 2000 to 2002. I think we're getting to that environment again, so I'm pretty excited, about looking forward, and lots of opportunities here outside of the overvalued things.
Exactly. And that brings us to the next chart,
Yeah.
as we love to highlight these, which is the percentage of stocks in the U.S. stock market that are outperforming the index. And over the last 2 years, we've just seen very narrow leadership. A third or less of stocks, which have been, unfortunately, the Mag 7 right now, that represent 35% of the stock market.
Right.
So most of the tech leaders have been outperforming the index and driving most of the returns, when the remainder of the stocks just haven't got the capital, haven't gotten the love. There's certain areas, of course, but it's mainly been the big stocks. And you mentioned in 2000, it was a very similar environment. 2 years of very narrow leadership. And then once that bubble burst, the capital had to go to other places. And then we saw most other stocks outperform the index in those years, as that capital reallocation led to, a bear market, but also a bull market in other areas, which a lot of value managers took advantage of. Could you just talk about active management and, the environment we're in today?
Yeah, and as I said, money just sloshes around from one place to another place. And what a great chart here to show 1998 and 1999, basically a duplicate of what happened in that market. 98 was bad because it was just a very small number of stocks that went up. And by the way, most of those stocks were down 70% in the next 2 or 3 years. But then it made it even worse in 1999. Right. So I always say when the really intelligent people who know the market seem like they don't know the market, whereas people who are uninitiated seem like the smart ones, it's time to run in the other direction. And that's exactly what we're seeing right here again. So I think there's going to be lots of opportunities. I think there'll be lots of ways to make some money going forward. But not in what's just done well in the past couple of years. And that comes to play. And what are we doing in clients' portfolios, right? We've really been adding a manager that has shown 15 years of not having a down year, just buying stocks that are undervalued, not out of favor, and boring. But he's done a fantastic job over a long period of time. We've been adding to that manager. He'll be rewarded in the next couple of years, we think. Then further to that, he has an alternative fund, which can actually short stocks that are expensive, which we've been adding to also for clients, which can actually make money pretty nicely if things go in the opposite direction. So, we're being proactive. We're not just sitting back and saying, hey, this is what's happening in the market and we've seen it all before, et cetera, et cetera. We're taking advantage of those opportunities, and there's going to be lots of them going forward. But it is on the managed money side, like you said. All right. In this sort of environment, picking individual stocks can be a risky business. But having certain styles, having a portfolio that fits together properly is the right way to go.
Exactly. And, to touch on that, we want to ensure in the portfolio that we own different asset classes that will lessen any volatility in the near term, such as bonds or alternatives, and will provide us with capital to reallocate when opportunities come about. We also want active managers that don't look like the index, have a high active share. So that means, the share of companies that they cross over with the S&P 500. And lastly, that have limited downside in the past versus the market. So they have good downside protection.
And I want to bring something up there, Martin. The portfolios that do the best over the long period of time never are at the top. They never do the best over a year, but they're never at the bottom over a year either. So what I mean by that is the key to doing well over long periods of time is not making a lot of money in the good times. It's avoiding losing a lot in the bad times, right? And I think that's what's really important, because mathematically, when you lose 50% of your money, you have to make 100% to get back to where you started from, right? And we've been talking this for a couple of years. And remember 2022, I was very happy when the market was down almost 20 in the US, and our portfolios were probably down 5 or something, right? 5 or 6, depending on the portfolio. Well, we didn't have much to overcome to get back to a break even, right? So taking big losses is a big problem, and that's why I think having portfolios that are stable with limited downside wins over the long run.
Yeah, and most of our clients are at the end of their career or in retirement. So what matters most to them is capital preservation. Yeah. They don't want to see their nest egg that they work so hard endure a large loss just to say, hey, don't worry, it'll bounce back in the next 1, 2, 5, 7 years, whatever it's going to be. That's not a conversation we want to have. We want to create consistency. So we're happy to talk with clients on their individual positioning, because each portfolio looks different depending on their own goals and risk tolerance. So this is a good segue to one of the initiatives we'll be launching this year. Is we want to lead some interviews of key professionals in our business. This can be one of two things: asset managers of various investment strategies in our portfolio. We really want to provide insights to what they're doing and how they're doing it. And lastly, internal professionals at Raymond James who assist us on various areas such as trusts, estates, planning, and so on. Can you comment on the value out of these interviews?
Yeah, because I've been doing this so long, and I think I'm a pretty good teacher. I like to take complicated things, make it easy to understand. I'm called upon by the press fairly frequently, so we send those out to people, and that's just me talking about the markets or what we see going forward. But because of that and the media and writing in the Financial Post and the Globe and Mail and all that I've done for years, we have pretty good access to these money managers too, right? So that's what we thought was the next step, is to interview some of these big money managers that we hire in our portfolios and just get their take. And I think I can interview them, ask some good questions, dig down into why they do what they do. And all of that makes our investors, our clients, feel more comfortable with what they're invested in, right? Because the key is, the more comfortable you are, the more information you have, the better you go through the ups and downs in the market, right? More information gives you more comfort, right? Always the case. Secondly, yeah, I mean, the markets are one important thing, but we can't control the markets. What we can control is where somebody is now, where they are, where they need to be down the road, and if they're on the right track to get there, right? And here at Raymond James, we've got a huge depth right? We've got estate planners, we've got state lawyers, we've got financial planners, we've got tax consultants, cross-border tax consultants, tax preparers, all this list of people, and we want to introduce those people more and more to clients, and we'll be talking about different areas as we go along. I think that's important this year. Kind of get people's mind off the markets and say, hey, what's important to me to get me to where I need to be.
Yeah, and we'll be launching these every month or so. So we look forward to it. It's going to be very, very exciting for our business. Lastly, we want to introduce Emily Miles. She's a new team member at Thompson Investment Partners. So she's just going to slide in right here and say hello. She's our lead client service specialist, as well as an investment associate, given her breadth of skills and experience. Emily, can you tell us a little bit about yourself?
Yes.
Hi, Emily.
So, hi, Bob. I joined the team in October of 2024, so it's been a few months now. Prior to that, I was studying at UBC, and I got my Bachelor's of Commerce there in 2022. I decided to take a quick gap year and spent some time in Victoria because I was doing my undergrad during the pandemic, so I wanted a little bit of space.
And Emily, do you play any sports?
I don't play sports right now. I do a lot of workouts and go to the gym, but when I was in high school, I played rugby.
Yeah,
15s and 7s for a few years.
fantastic. We got a big rugby tournament in Vancouver here coming up, so hopefully we can get out to that and see what they're doing.
Yep, that'd be exciting. I've got a few high school provincial championships under my belt and know some of the girls playing, so it'd be nice to see them.
And Raymond James is actually sponsoring women's rugby in Canada, the national team. So Raymond James is actually very involved in women's rugby right now. So yeah, lots of opportunities. There will be a lot of fun to see them progress.
Yeah, it's exciting. Hopefully we can make that next medal go from Olympic silver to Olympic gold. You never know.
Amazing.
Yeah, and just so everybody, Emily's client service specialist as well as an investment representative. So she is licensed. She can take orders. She can put in orders, and also she's here to do all the administration and everything that's important as far as organizing everything that you need to have your accounts here. So we're really excited to have Emily on board. Fantastic addition to the team, and now I think we have a very good team to do anything for our clients that they need. So we're pretty excited to have Emily on board. So thanks for coming on camera.
Thanks, Bob.
All right.
And just to wrap up, I just want to thank everyone for joining and to look out for our first interview with either an asset manager or someone from Raymond James in the next month or so. So with that said, have a great year. Please reach out to us if you need, and we look forward to it. Take care.
Okay. Thanks, everybody. We'll see you next time.
Bye.